If you think the market goes up just because people buy and goes down just because they sell, you are a very naive person. I would love to be your friend because you are the perfect prey. Research shows that the majority of people do not make decisions based on data or fundamentals. They make decisions based on rumors and price action. Please pay attention, not the price itself, but the movement of the price. Why? Because two hormones in the human body react to this movement: adrenaline and cortisol. When these kick in, logic leaves the room and we start acting on our primal impulses. Let me give you a simple example. Imagine you go to a currency exchange booth at JFK Airport. You buy euros for $5,000. If you try to sell those euros back to the same booth 5 seconds later, they will give you $4,900. That difference is the spread. Did the booth steal your money? No, they charged you for a service. What was the service? Liquidity. Instead of walking the streets of New York trying to find someone who wants to sell euros, you executed the trade instantly. To do this, that booth holds both dollars and euros in its vault. This is what we call liquidity. This is the market maker. We love them and we hate them. In the stock market, they have buy and sell orders ready at all times, so you can trade instantly. They keep the market deep. Here is the truth. Unless there is a massive global event outside of their plan, nothing moves in the system without their permission. Not even a bird flies here if the market maker doesn't want it to. Don't think about the GameStop anomaly. That's a different story for another time. So, where does the market maker get the shares? Did they buy them from the market? No. Before a company IPOs on the New York Stock Exchange, they don't just go to the SEC. They go to the market makers first. They hand over control of the shares that will be traded. So in this mechanism, they have the shares in one hand and the money in the other. Their job is to provide liquidity and profit from the spread. But their real function is something darker. If you think the market moves based on your $5,000 savings account, take a breath. It has nothing to do with you. It has everything to do with the banking system. Capitalism says, I printed this money to turn the wheel. Money sitting in savings accounts is dead capital. It needs to return to the production cycle. In economics, when we add up cash in circulation plus checking and savings deposits, we call it the M2 money supply. When M2 grows like a truck with no brakes, the balance breaks. So when you take your money out of the bank and put it into the stock market, you are actually taking dead fuel and injecting it back into the system. The market moves based on M2 data. There is a growing pie and everyone thinks they see it. But remember, the market maker has shares in one hand and cash in the other. They can drive the price wherever they want just by trading between their own accounts. So let's talk about the god of the exchange. I am going to try to tell you one of the darkest secrets of Wall Street without getting into trouble. This truth is so disturbing. According to sources, 95% to 97% of retail traders consistently lose money. And here is the kicker. People lose the most money during bull runs. Is this a coincidence? No, it is systematic. There is a famous rule on Wall Street called the 90-90-90 rule. 90% of retail traders will lose 90% of their money in 90 days. Why? Because market makers and PR firms guide you to do exactly the opposite of what you should do. Now we are facing manipulators in God mode. Does this sound familiar? You have money in the bank. Everyone is talking about a stock on Reddit or Twitter. I put in $100, now it's $250. You check the app. The price is $25. They say it's going to $200. It keeps rising. You think, let me catch this before it flies. You buy with half your savings. Then the price stops. It starts to pull back. The forums say, it's just a correction, buy the dip. Suddenly, a quick pump happens. You say, "See, it's turning." You put the rest of your money in. You lowered your average cost. You feel smart. But then, it starts bleeding. Slowly at first, then violently. The forums go silent. You put in $1 million. Now it's worth $700,000. A week passes. It drops faster. Am I going to zero? Should I sell before I go bankrupt? 1,000 voices scream in your head. Stress is at an all-time high. Your finger hovers over the sell button. You sell everything. Your heart is pounding. Your hands are shaking. And then, a week after you sold, the price goes back up, past where you bought it. You think, what kind of bad luck is this? You buy back in to recover your losses, and it dumps again. Recognize that feeling? A sharp pain in your chest. You made 3 decisions. Enter the market, buy the pump, panic sell the dump. But did you really make those decisions? Most of the accounts you saw on social media were bots or PR firms paid to create noise. And biologically, you were hacked. The stress and rapid movement triggered 2 hormones, adrenaline and cortisol. These hormones send a signal to your brain, we are in danger, escape. In your brain, there is the prefrontal cortex. It handles logic, math, and strategy. Then there is the amygdala. It handles fear, panic, and survival. Under that chemical attack, your amygdala hijacked your brain. It shut down the logic center. So the decision to sell at the bottom? You didn't make that decision while sitting in your office. Someone else made it for you. The market maker's manipulation technique is to attack your amygdala, forcing you to act on impulse, transferring your liquidity into their pockets. They don't care how you feel. They analyze what you do. Their algorithms see your pain points, and they will keep pushing until you break. Fake breakouts, stop hunts, massive candles. Millions of people did the exact same thing you did, at the exact same time. Unless you have insider information, which you won't find on the internet, we have to use different strategies. Psychological analysis, smart money concepts. Look, markets are perfect places to build wealth. But before technical analysis, you must understand capitalism and the market maker. Without them, there is no market. You couldn't buy a single stock. Who needs to watch the market maker? Day traders and swing traders. If you are holding an asset for less than a year, this is your battleground. If you are a long-term investor, you analyze the fundamentals. You buy when there is blood on the streets, and you wait for years. You don't care about the noise. For the rest of us, we operate in the gray area between good and evil. We try to keep our perception clean under heavy bombardment. Are we really the ones making the decisions in our lives? Or is it just another algorithm? Thanks for listening.